Hello and welcome to the lecture for part 1 of chapter 8. So chapter 8 deals with long-term operational assets. So assets that last a long period of time, meaning more than a year, that we use in the operation of the business. That's what we define as long-term operational assets. So there would be things like machinery and buildings and trucks and computers and things like that. So we talked in chapter 3, I believe it was, about depreciation. We introduced that concept just in a very simple way. So now we're going to kind of take a deeper dive into that and talk about different methods of depreciation and gains and losses and revising estimates. So we'll talk about all of that in this chapter. So let's talk about, first of all, an overview of assets. So you might notice that we've been covering from chapter, I think it's 5 on, we've been talking about different types of assets. So as an example, we've talked about current assets. Those are assets that are either going to get used up or become cash within the upcoming 12 months. So as an example, we have cash, accounts receivable, which we covered last chapter, inventory, which we have covered, LIFO, FIFO, and those methods. And so that covers most of our current assets. So now we're going to talk about long-term assets. And those long-term assets, things that don't get used up within a year, fall into two different categories. One is tangible assets. So those are assets that we can touch and feel. And they fall into categories like property, plant, and equipment. So property obviously is land, okay? Well, excuse me, I have land as a separate category there. So property in this case would be buildings, that sort of thing. Plant would be our factory, and then equipment, of course, is machinery, forklifts, trucks, computers, all of that kind of stuff. We also have natural resources, so we might be a company that's in the timber business, so we own stands of trees. We might be a mining company, so we own resources underground, or a fracking company where we own resources underground like natural gas. And then we'll also have a category called land. The reason we keep land separate is land doesn't wear out, so we don't depreciate land. So we consider that kind of a separate type of tangible asset. I'll talk about depreciation more in a minute. We also have a category called intangible assets. So those are things that we own, that we use in the long-term operations of the business, but that we can't touch and see. So those fall into two categories. Ones that have an identifiable usable life, like a patent or a copyright, and then those that have an indefinite useful life, which we'll talk later about. Goodwill and trademarks fall into that category. There is no life on that. So the cost of a fixed asset is, of course, the purchase price of the fixed asset, but then all of the other amounts that are spent to get it ready to use in the business. So that might include inbound freight. If I buy an asset and the asset's located in Tampa, Florida, well, then I got to get it to my factory here in Lacey. So the freight to get it from Tampa to Lacey is going to be part of the cost of the asset. In most cases, I have to pay sales or use tax on the purchase of that asset. I might have to make repairs to it. If it's a used piece of equipment, there might be some damage or things that aren't working properly that have to be fixed first. And there's a big area here. I might have to modify it to work in my company or to work making my products, okay? And then lastly, I have to test it, which might mean consuming some materials. It might involve labor, those kinds of things. So all of those costs of getting it tested to make sure it's ready to turn on and start making parts, those are all included. All of those costs are included in the cost of the fixed asset. So as an example, you might decide that you want to start your own business and be a delivery driver for Amazon and own your own Sprinter van. Well, in that case, you would go buy a Sprinter van from a dealership, and then you'd have to spend money to have the paint job put on it according to Amazon's color schemes and requirements. You might have to spend money to outfit the inside of it, and it looks like they've got some electronics on there as well that are required. So you'd spend money in addition to buying the truck, or the van rather, you'd spend lots of money getting it ready for the purpose for which you're going to use it. So all of those costs would be included in the cost of the asset. So depreciation is the periodic recording of the cost of the fixed asset. So it's not an attempt to measure market value or a decline in market value. It's an allocation method. So it's not a valuation method, it's an allocation method. So assets depreciate for a couple of reasons. One, they physically wear out. So that's a type of physical depreciation. If any of you have driven a vehicle that has over 250,000 miles on it, you know that vehicles wear out after they've been driven a long ways. So that wearing out, or the drop in value of the asset, is the act of consuming the asset. So we want to spread that over its life. There might also be functional depreciation. So say as an example, 15, 20 years ago, I bought all of my salespeople flip phones. Those flip phones can still make a call, but are they functionally still what I want my salespeople to have? So although they haven't physically worn out, they have functionally ceased to be of value. So that drop in value over its life based on either functionality or physical wearing out, it is a cost. It's a type of cost. So we want to record that cost over the period of time in which we get the benefit from the asset. So depreciation expense is based on three factors. One is the initial cost, and again, that includes everything it costs to get the asset onto my property and working, okay? Next is the expected useful life, and that's going to be based on an estimate, okay? We're going to make our best judgment about not necessarily how long the asset's going to last, but how long we're going to use it. And then I'll also have to estimate salvage value. So that's what it's going to be used, what the value will be at the end of its useful life. And scrap value or residual value are other terms for that. So the initial cost minus the salvage value is what we call the depreciable cost. That's how much we're going to depreciate, is that change from cost to salvage value. And I'm going to spread that over the useful life by recording periodic depreciation expense. So there's an asset life cycle, which is we acquire funding to buy an asset, we buy the asset, we use the asset, and then we retire the asset, meaning we sell it off or dispose of it in some way. So that's where the use of the asset, that's where we want to record depreciation, is during the time in which we use it. And there's a couple of different methods to use, and you can see that far and away the majority of people use the simplest method, which is straight line. And I'm going to show you the other methods, but that's what we'll kind of focus on because that's what you're most likely to see. So in this first case, let's look at straight line. So the straight line method is going to produce the same amount of depreciation in each period. So in this example here, we have a $24,000 machine that has a $2,000 salvage value and a 5-year useful life. So the annual depreciation is the cost minus the salvage value, which is the depreciable cost, divided by the useful life. So I have 24,000 minus 2,000, or 22,000 divided by 5 years. I'll record $4,400 per year of depreciation using this method. So here's an example in a transaction grid. So I start out with, in this case, I have 10,000 in cash, 24,000 in equipment, and 34,000 in retained earnings. At the end of the first year, I record a depreciation expense, which increases my contra account, that negative balance in accumulated depreciation, and reduces my retained earnings. I recognize an expense. I do that again the second year. I do that again the third year, I do that again the fourth year, and finally the fifth year. So I've done the same entry at the ends of 5 years. And you can see I end up with total accumulated depreciation of negative $22,000 against equipment value of $24,000. So the net amount of those two numbers is $2,000, which is what I estimated my residual cost to be. So the next method is actually my favorite method because I think it does the best job of matching expense with the benefit. So in this case, it works just like the straight line method, except my denominator is going to be some units of output. So it might be hours run on a machine in this case. It could be miles driven on a truck, that sort of thing, parts produced. So I'm going to make an estimate of how much use I'm going to get out of the piece of equipment, and that's what I'll use to depreciate it. So in this case, I'm going to come up with a depreciation per unit. So I take cost minus residual value, that's the same. In this case, I divide by total units of output. So I think this machine is going to run 10,000 hours. So that gives me $2.20 per hour run. So now I can go look at how many hours the machine has run, and I can record depreciation based on that. Or as an example with a truck, I might use miles, and I could look at on the odometer and see how many miles a truck has driven and record the appropriate amount of depreciation. The nice thing about that is if I have one year where I really drive the heck out of the truck, I'm doing things all over the place, putting a lot of miles on it, I also am charging a lot for delivery fees, so I should record more depreciation for that. If the next year I hardly do any deliveries for whatever reason and I hardly drive the truck at all, I'd record very little depreciation. So it's kind of a perfect matching method. The reason this isn't used more, in my opinion, is laziness. Accountants don't want to get up from their desk and go look at the odometer, so they use the straight line method because that's simple. The next method is the double declining balance method, which you probably won't see much in the real world, but it's for companies that might want to do an accelerated type of depreciation. So they might want to record more depreciation early in the product's life and less later. So let's say as an example that you have a company that made a really cool case for the new iPhone 12. You're going to sell a lot of them in the beginning, and you're probably going to sell much less of them over, say in the 4th or 5th year when there's not as many people with, now that the iPhone 23 has come out and not many people are using the 12. So if that's the case and you have a machine that you have that makes that case for the iPhone 12, you might want to record more depreciation up front and less on the tail end. So this is a method that allows you to kind of front end load the depreciation that you take, so it matches the revenues a little bit better. So the first step is to determine the straight line percentage based on the life of the asset. So if it's 5 years, the straight line rate would be 20% per year, right? 1/5 per each year, 1/5 is 20%, and you would double that. So in that case, if it's a 5-year asset, we would use 40% instead of 20%. Then I'm going to compute the depreciation expense by multiplying the balance, the beginning book value for the period, by that new doubled rate. And I'm going to be careful not to go below the residual value. So I'm going to show you an example here. So I have an asset that costs the same asset we've been talking about. And now I'm going to ignore the salvage value and just start with the total cost, because that's the book value, right? At the beginning, I haven't depreciated it at all, so the book value is the cost. So I start with $24,000. Multiply that by 40%. The first year I take $9,600 of depreciation. So 24,000 minus 9,600 leaves me with a book value of 14,400 at the end of the year, which becomes my amount at the beginning of the next year, times 40%, so I record 5,760 of depreciation my second year. That drops my book value to 8,640, and so on. I keep doing that math. When I come to the very end, in year 5, I've got a beginning book value of 3,110.40. If I multiplied it by 40%, I would record too much depreciation because I don't want the book value to go below the salvage value. So I fudge that number, 1,110.40, so that I end up with a book value of 2,000. So I hope that makes sense. I will end it here, and I will start in the next lecture talking about gains and disposals of selling assets. So if you have any questions, as always, please give me a call. Thank you.